If you only look at this chart, the US economy looks unstoppable. The trend of the S&P 500 has been relentlessly up for 2 decades, pushing the market to all-time highs. But if you layer on consumer sentiment, the story completely breaks down. While the stock market is signaling a historic boom, the mood of the average American has collapsed to levels we typically only see during deep recessions. This is one of the widest divergences in modern history, and it forces us to ask, why do Americans feel so broke when the country is supposedly so rich? The answer is that the stock market is no longer an accurate representation of the real economy. This chart shows stock ownership by net worth. The bottom 50% of Americans, they own just 1% of all stocks. Meanwhile, the top 1% now owns 50% of the market. Underneath the booming market narrative, most Americans feel trapped in economic insecurity as wealth inequality worsens. And it's a vicious cycle, because worsening inequality is actually bad for economic growth. Just look at the Gini index. This is basically the thermometer for inequality. Since 1980, that temperature has risen by over 20%. The US is now more unequal than it's ever been. And this isn't just a moral or societal issue. History suggests it's an economic problem too. This chart measures how long countries sustain economic growth compared to their level of inequality. The pattern is clear. Dots on the right represent unequal societies. Notice how they're lowered down, meaning their growth spells are shorter than more equal societies. Therefore, as the gap widens, economic stability actually drops. When wealth concentrates at the very top, the engine of the economy, the middle class, runs out of fuel. Here's why that engine is sputtering. For the wealthy, the top 1%, their wealth is built on equities, assets that produce cash flow and grow with the economy. As US companies prosper and rake in profits, so do the 1% invested in them. But for the bottom 50%, their main asset is usually real estate, their home, and that's moving further and further out of reach. Just look at this chart, which shows the ratio between the average home price and median household income. It now takes the average family 7 years of savings just to afford a down payment on a house. This effectively locks the majority of Americans out of the number one way the middle class has historically built wealth. Therefore, to bridge the gap between wages and the cost of living, people are turning to debt. US household debt spiked by nearly $200 billion in just 1 quarter of 2025. So while the top 1% is leveraging assets to get richer, the bottom 50% is leveraging debt just to survive. What drove this wedge between the wealthy and the rest is the same force that's fueled the economy for the past 50 years: globalization. And you can see it on this chart, which measures total US imports and exports going back to 1950. Beginning in the 1980s and ramping up in the 2000s, the US began importing cheap goods, particularly as China opened up to global trade. Corporate profits soared as a direct result. Look at how closely they correlate. So, globalization was great for Wall Street and the 1% who own most of the stocks. But globalization came at a cost: domestic manufacturing jobs, which were once the heart of the middle class. The US exported its manufacturing base, and millions of middle-class ladder jobs vanished. And even as corporate profits and productivity have soared, wages have not. This created a massive disconnect between how hard people worked and what they were paid. Take a look at this chart, showing productivity and worker pay. From 1948 to 1979, productivity and hourly pay grew together. But starting around 1979, they split. Productivity kept climbing. Workers were generating more value than ever, but their compensation flatlined. Since 1979, productivity has grown 2.7 times faster than average pay, and the wage growth that has taken place has been highly unequal. The top 1% captured the value of higher productivity, seeing their income grow by 326% since 1980, compared to just 73% income growth for the middle 60%. That's a sure sign that those at the top are benefiting from soaring profits, while those at the bottom are left out. But now we may be seeing the end of this era of easy profits through deglobalization. The average tariff rate in the US is now near 20%, the highest it's been since the 1930s. These protectionist policies have choked off international trade and prompted other countries to respond in kind. As a result, US trade with other countries is tapering off and showing signs of slowing down. We're looking at deglobalization. As you can see, this is not a new process. It's been declining since its peak in 2010. The tariffs are designed to return those manufacturing jobs back to the US and mitigate inequality, and it's likely too soon to say with any certainty how effective this will be. We're seeing some early signs of this rotation. Growth in structural metals manufacturing is already ticking up, with more than 10,000 new jobs created between July 2024 and July 2025. But the US is still hemorrhaging manufacturing jobs in motor vehicle parts and semiconductors. Combined, these two sectors have shed more than 40,000 jobs in that same same period. But, and here is the critical trade-off for investors, while deglobalization might help close the wealth gap by raising wages for workers, it likely means the era of cheap goods and easy corporate profits is over. Fixing the wealth gap might mean structurally higher inflation and lower stock market returns for the next decade. At Capital.com, we'll keep tracking these shifts in trade and labor data so you never miss the turn. Hit like and subscribe to stay ahead. Thanks for watching.